More than 90% of people who actively invest in the stock market underperform the market itself over a 10-year period. Not because they lack information, not because they don't understand investing, financial planning, or portfolio diversification, but because their brains are wired to sabotage them. Here is the uncomfortable truth. Financial freedom is not lost in the stock market, crypto, real estate, or bad ROI decisions. It is lost inside the human nervous system. So here's the real question. If the global economy rewards patience, discipline, and long-term strategy, why do intelligent people keep making impulsive financial decisions that destroy their portfolio, their budgeting discipline, and their long-term wealth? The answer begins with dopamine. Dopamine is not pleasure. Dopamine is anticipation. It is the chemical that tells your brain something important might happen next. Modern neuroscience shows that dopamine is responsible for how humans evaluate risk, delay rewards, and make decisions under uncertainty. And money is nothing but uncertainty packaged as opportunity. Every time you think about investing, checking the stock market, buying cryptocurrency, taking a mortgage, using a credit card, or adjusting your financial planning strategy, dopamine activates first. Not logic, not math, not spreadsheets. Dopamine. This is why two people with the same income, the same banking access, and the same financial knowledge can end up with completely different outcomes. One builds wealth. The other repeats financial stress. Recent studies in behavioral finance and neuroeconomics show that dopamine levels influence how people perceive risk and reward. When dopamine activity increases, people feel optimistic. They expect higher returns. They believe their investing decisions are better than average. This is when people overtrade in the stock market. This is when speculative crypto behavior increases. This is when people abandon budgeting rules and chase fast ROI. When dopamine activity decreases, fear takes over. Losses feel heavier. Risk feels dangerous. People sell assets too early. They avoid investing altogether. They delay financial planning decisions that would benefit them long term. This creates a destructive loop. Short-term wins increase dopamine and encourage more risk. Short-term losses suppress dopamine and trigger panic. Markets don't just move on data, they move on collective human biology. Now let's place this inside the current global economy. The world economy today is not collapsing, but it is fragile. Global growth continues at a slower pace, driven largely by technology, automation, and capital concentration. Artificial intelligence is reshaping productivity. Financial systems are becoming more complex. Banking, investing platforms, and markets move faster than ever. At the same time, inflation pressures are easing, interest rate expectations are shifting, and central banks are attempting to stabilize uncertainty rather than eliminate it. This creates a unique environment, an economy where long-term investing is rewarded, but short-term emotional behavior is punished. And dopamine is extremely sensitive to short-term signals. News headlines, market volatility, social media success stories, crypto hype cycles, real estate booms. These are not neutral information streams. They are dopamine triggers. Every headline promises opportunity or disaster. Every chart movement feels meaningful. Every notification demands reaction. Dopamine does not understand long-term ROI. It understands urgency. This is why people constantly check their portfolio. This is why stock market dips feel personal. This is why cryptocurrency volatility feels addictive. This is why real estate speculation explodes during low-rate environments. The brain confuses stimulation with opportunity. Now consider the United States economy specifically. Consumer spending remains strong. Employment supports income stability. Banking systems continue to function. But beneath the surface, uncertainty dominates. Government debt, political instability, policy reversals, global trade tension. These conditions amplify emotional decision-making. During uncertain times, dopamine becomes unstable. People either chase risk aggressively or avoid it completely. This is why extreme behaviors increase during volatile markets. Some people over-leverage with credit cards. Others freeze and stop investing altogether. Some chase speculative ROI in crypto. Others hoard cash and lose purchasing power. Financial freedom disappears at the extremes. It does not disappear because of lack of opportunity. It disappears because the nervous system becomes dysregulated. This is where most financial advice fails. It assumes humans are rational. They are not. Humans are predictive machines guided by dopamine. Understanding this changes everything about investing, budgeting, and financial planning. Financial freedom is not about eliminating dopamine. It is about regulating it. People who build sustainable wealth do not feel less excitement or fear. They structure their environment to reduce impulsive reactions. They automate investing. They limit exposure to constant market noise. They create rules that protect their portfolio from emotional decision-making. They understand that AI, automation, and global capital flows reward patience more than speed. They do not react to every market movement. They do not chase every trending asset. They do not confuse activity with progress. This is why long-term investors outperform most active traders, not because they are smarter, but because they interfere less with themselves. One of the most important dopamine concepts is reward prediction error. Dopamine spikes when outcomes exceed expectations. It drops when outcomes disappoint expectations. Markets exploit this constantly. Optimistic projections inflate expectations. Corrections feel devastating. Media exaggerates extremes. This keeps dopamine unstable and judgment distorted. This is why people feel euphoric during bull markets and hopeless during downturns. But neither state reflects reality. Reality moves slower than dopamine. Financial freedom requires slowing perception, not slowing ambition, not avoiding investing, not rejecting opportunity, but slowing reaction. This is especially important in modern financial systems. Algorithms trade in milliseconds. Markets respond instantly. Information travels faster than human judgment. Your nervous system was not designed for this speed. When dopamine is overstimulated, time horizons collapse. People prioritize short-term gains over long-term stability. They underestimate compounding. They abandon financial planning strategies prematurely. This is why budgeting fails for many people. Not because budgeting doesn't work, but because dopamine resists delayed rewards. Spending activates immediate dopamine. Saving delays it. Using a credit card feels painless in the moment. The cost arrives later. This is not a moral failure. It is biological. Real estate decisions follow the same pattern. During housing booms, dopamine inflates confidence. Mortgages feel safe. Risk feels invisible. During downturns, fear dominates. Opportunities are ignored. People hesitate when prices are lower. The same asset produces opposite reactions. Depending on dopamine state, financial planning is the art of neutralizing this bias. It is not about predicting markets perfectly. It is about staying consistent while others react emotionally. The people who win financially understand something simple. Money compounds. But behavior compounds faster. Small emotional decisions repeated over years determine outcomes. Chasing short-term ROI destroys long-term portfolio growth. Avoiding risk entirely destroys purchasing power. Overusing credit cards erodes future flexibility. The future economy will amplify these effects. AI will accelerate productivity. Capital will concentrate faster. Opportunities will be unevenly distributed. Those who regulate their internal reward system will adapt. Those who don't will feel constantly overwhelmed. Financial freedom is not about escaping work or responsibility. It is about escaping reactive behavior. It is about choosing when to act rather than being forced to react. When you understand dopamine, investing becomes calmer. The stock market becomes less emotional. Crypto becomes a strategy, not a gamble. Budgeting becomes sustainable. Financial planning becomes realistic. You stop mistaking excitement for opportunity. You stop mistaking fear for wisdom. You begin operating from structure rather than stimulation. And this leads to a final realization. The greatest risk to your financial future is not inflation, not the stock market, not cryptocurrency volatility, not real estate cycles, not banking systems, and not interest rates. It is your inability to regulate how your brain responds to uncertainty. So here's the final question you should sit with. If financial success depends less on intelligence and more on nervous system regulation, then how many of your financial decisions so far were truly rational, and how many were simply dopamine in disguise?